The shadow of the 2026 global financial storm is already looming. Compounded risks, including soaring debt, rising interest rates, and geopolitical conflicts are accelerating the weakening of the US dollar's credit standing and the trend of de-dollarization. This article provides an in-depth analysis of the causes of these risks, their transmission pathways, and potential countermeasures, offering critical insights for market participants to anticipate crises and mitigate risks. On the quiet Christmas Eve of 2025, a warning about the impending 2026 global financial storm echoed like an alarm bell. This was not alarmist speculation, but a forecast grounded in the real fragility of the global economic and financial system. As the clock struck midnight, electronic screens across major global financial markets continued to flicker. Behind seemingly stable index curves, undercurrents of high debt, interest rate volatility, and trade imbalances surged relentlessly. The shadow of a storm capable of surpassing the 2008 financial tsunami had already quietly enveloped the world economy. To grasp the weight of this warning, we must first revisit the true state of the global economy in 2025. That year, the global economy demonstrated fleeting resilience amid multiple pressures. The International Monetary Fund (IMF) raised its full-year growth forecast to 3.2% in its October World Economic Outlook report. Yet this resilience felt more like the last gasp of a spent force, concealing structural crises too deep to ignore. Growth divergence among economies intensified markedly. The U.S. economy barely maintained a 2.0% growth rate in 2025, with the IMF projecting a further decline to 1.7% in 2026. Debt burdens became the primary constraint on transformation for most nations. As early as the first half of 2025, global public debt as a percentage of GDP had already surpassed 105.2%, setting a new record high from 2024's 103.6%. Peacetime debt records continue to be broken, and this figure is still climbing at a visible pace. The reason the debt snowball keeps growing is closely linked to the global easing policies implemented after the pandemic. Following the COVID-19 outbreak in 2020, central banks worldwide activated money printing mode. Loose monetary policies continuously released liquidity like an open faucet, followed by successive fiscal stimulus packages. While these measures effectively stabilized economies in the short term, acting like a shot in the arm for near-stagnant economies, they also sowed the seeds for subsequent debt crises. In the early stages of the pandemic, global interest rates were pushed to historically low levels, with some countries even implementing negative interest rate policies. High debt appeared like cheap candy in this low-interest rate environment, prompting governments and businesses worldwide to aggressively leverage up for financing while selectively ignoring the potential debt repayment pressures that could arise once rates rebounded. Markets were then steeped in the illusion of central bank bailouts, assuming central banks would intervene regardless of market turbulence. This blind optimism further inflated debt levels. In 2022, global inflation surged like a runaway horse, shattering the prolonged low-interest rate environment. To curb inflation, central banks worldwide were forced to initiate the most aggressive rate hiking cycles in decades, transforming cheap candy into heavy shackles overnight. The Federal Reserve raised its benchmark rate from near-zero levels to a range of 5.25% to 5.5%. Within 2 years, the European Central Bank ended its 8-year negative interest rate policy, raising its benchmark rate to 4.5%. Even the Bank of Japan, long adhering to ultra-loose policies, made a policy adjustment in July 2025, allowing the fluctuation range of 10-year government bond yields to expand to plus or minus 1.0%, signaling a clear policy shift. The sharp rise in interest rates has dramatically increased already high debt burdens, particularly for the United States and Japan, the two economies with the largest debt scales. Interest payments have become a heavy burden on fiscal budgets. By the third quarter of 2025, Japan's government debt-to-GDP ratio reached 263.4%, while the U.S. federal government's debt-to-GDP ratio hit 122.8%. Estimates indicate that a 1 percentage point increase in interest rates would require Japan to pay an additional $120 billion in annual interest, while the United States would face an extra $360 billion. These massive interest payments act like ever heavier weights, pushing both nations' finances to the brink of suffocation. Japan's debt predicament is particularly unique, as it is simultaneously crushed by the twin burdens of skyrocketing debt and shrinking population, creating a vicious cycle that is difficult to break. The 2025 Population Dynamics Annual Report released by Japan's Ministry of Internal Affairs and Communications shows that in 2024, Japan's birth rate was only 682,000, setting a new record low for the 9th consecutive year. The proportion of the population aged 65 and above rose to 31.5%, placing Japan among the world's most rapidly aging nations. Meanwhile, the working-age population shrank to 58.3%, indicating a persistent decline in labor supply. As the core driver of economic growth, the continuous reduction in the workforce resembles a constant loss of vital blood, gradually sapping Japan's economic vitality. Simultaneously, the accelerating pace of aging forces the government to continually increase social security expenditures, including pensions and healthcare coverage. Sluggish economic growth has stalled tax revenues, while rising social security expenditures have further widened the fiscal deficit. The government has resorted to continuously issuing more government bonds to bridge the gap, which in turn fuels the expansion of debt. This ultimately creates a vicious cycle. Population decline gives economic stagnation, gives widening fiscal deficit, gives rising debt. Historical precedent shows no nation has ever escaped unscathed from the dual pressures of persistent population decline and accumulating debt. Japan's predicament mirrors that of several developed economies globally, albeit in a more severe form. Compared to Japan's chronic ailment, America's debt problem resembles an acute explosive poised to detonate at any moment, characterized by suddenness and intense impact. By December 2025, U.S. national debt had surged past $38.7 trillion, a historic peak, and continues to grow rapidly at a daily rate of tens of billions of dollars, showing no signs of slowing. More dangerously, the ongoing partisan gridlock over fiscal issues has prevented the federal government from implementing effective policies to control debt levels, gradually turning the debt problem into a tool for political bargaining. In 2025, the U.S. government experienced a record-breaking shutdown due to partisan disagreements over the debt ceiling. Although a temporary bill eventually resolved the crisis, it exposed deep-seated flaws in America's fiscal governance. IMF projections indicate that by 2030, the U.S. government debt-to-GDP ratio will rise by over 20 percentage points from 2025 levels, reaching 143.4% once again, breaking the post-pandemic record. The sustainability of U.S. debt has become one of the most pressing concerns for global financial markets. Risks to the U.S. economy extend beyond debt levels, with the bubble-like trend in its stock market equally alarming. In 2025, fueled by an AI investment boom, the U.S. stock market displayed a false prosperity. The Nasdaq index surged approximately 21% within the year, and its gains since the end of 2022 exceeded 120%. The market capitalization share of 7 major tech giants, including Nvidia and Microsoft, reached historic highs, with NVIDIA's market cap briefly surpassing $5 trillion. However, this prosperity was not underpinned by robust growth in the real economy but rather stemmed from the continuous expansion of valuation bubbles. Data indicates that in 2025, the ratio of total U.S. stock market capitalization to GDP exceeded 210% at one point, far surpassing historical averages. This ratio severely deviated from economic fundamentals, bearing striking similarities to the dot-com bubble era of the late 1990s. Although current risks in the U.S. stock market have not yet reached the levels seen during the dot-com bubble, high valuations and market concentration make global financial markets more vulnerable to sudden adjustments, with risks potentially spreading rapidly across different markets and asset portfolios. Experienced investors chose to liquidate all their U.S. stock holdings precisely because they recognized the fragility of this bubble-driven prosperity, taking concrete action to avoid potential risks. More critically, the dollar's credit long, the bedrock supporting U.S. debt and the economy, showed visible cracks in 2025, and these fissures continue to widen. The dollar's status as the global reserve currency once served as America's get-out-of-jail-free card. Nations had no choice but to hold substantial amounts of dollars and U.S. treasuries for international trade and foreign exchange reserves, enabling the U.S. to effortlessly bridge fiscal gaps through currency and debt issuance. However, as global multipolar trends advance and the U.S. increasingly wields the dollar as a political tool while abusing its monetary power, the currency's international credibility has been severely damaged. The wave of de-dollarization is accelerating worldwide. In the first half of 2025, the US dollar index plummeted by 10.8%, marking its worst performance since 1973 and serving as a stark commentary on global financial markets. Data released by the International Monetary Fund on the composition of global foreign exchange reserves shows that the dollar's share in reserves dropped from 57.79% at the end of the first quarter to 56.32% at the end of the second quarter of 2025. This marks the 11th consecutive quarter below 60%, hitting a 30-year low. This shift reflects a profound transformation in the foreign reserve allocation logic of global central banks, moving away from a focus on single currency dollar assets toward diversified, dynamically balanced strategies. Increasingly, nations are reducing their reliance on dollar-denominated assets and instead accumulating gold non-sovereign credit risk-free physical asset as a mainstream choice for asset allocation under the de-dollarization narrative. The European Central Bank's annual report, The International Position of the Euro, notes that gold's share in global foreign exchange reserves has risen significantly. By 2024, gold accounted for 20% of global reserve assets, surpassing the euro's 16% and trailing only the dollar's 46%, making it the world's second-largest reserve asset. For the first time since 1996, gold's share in central bank reserves exceeded that of U.S. Treasuries. Ray Dalio, founder of Bridgewater Associates, stated bluntly, "Gold is beginning to replace U.S. Treasuries as the risk-free asset." Data from the World Gold Council corroborates this trend. From 2022 to 2024, global central banks' annual gold purchases exceeded 1,000 tons for 3 consecutive years. In the first 3 quarters of 2025, net central bank gold purchases reached 634 tons, though below the exceptionally high levels of the previous 3 years. This figure remains significantly higher than the pre-2022 average. Driven by this central bank buying wave, gold prices have continued to strengthen. Since the start of 2025, spot gold has risen nearly 68%, making it one of the world's best-performing assets. The People's Bank of China's accumulation efforts are particularly noteworthy. To optimize its foreign exchange reserve structure and reduce reliance on dollar-denominated assets, the PBOC has steadily increased its gold holdings. By December 2025, the PBOC's gold reserves reached 2,592 tons, accounting for 7.8% of China's total reserve assets. However, this proportion remains significantly below the global average of 22.4%, indicating substantial room for further gold accumulation. The PBOC's sustained purchases will provide long-term, stable demand support for global gold prices. Professional institutions predict through quantitative models that if global central banks and gold ETFs maintain their 2025 purchasing momentum in 2026, gold prices could climb to $4,948 per ounce. Under an optimistic scenario, prices may even surpass $5,500 per ounce. The weakening of the US dollar's credit standing and the acceleration of de-dollarization trends are closely linked to America's reciprocal tariff policy implemented in 2025. Since that year, the U.S. has enacted multiple tariff measures, most notably reciprocal tariffs, to achieve objectives, including promoting manufacturing, reshoring, reducing the goods trade deficit, and alleviating federal government debt pressures. These actions have caused significant disruptions to global trade patterns and financial markets. According to calculations by the Peterson Institute for International Economics, the average tariff rates on imports from China and other regions rose from 20.7% and 3.0% in January 2025 to 47.5% and 18.5% by the end of November 2025, with the tariff rate on Chinese imports peaking at 145% in April. Although significantly reduced following negotiations, it remained at a relatively high level of around 45%. The impact of U.S. tariff measures was unprecedented. Its unilateral approach of imposing reciprocal tariffs based on bilateral trade deficits severely undermined the foundations of the multilateral trading system built upon WTO rules. In April 2025, global trade tensions escalated sharply under the reciprocal tariff policy, triggering a rare triple whammy of stock, bond, and currency declines in U.S. financial markets. From April 3rd to 4th Eastern Time, all three major U.S. stock indices suffered consecutive heavy losses, with the Dow Jones, Nasdaq, and S&P 500 indices cumulatively falling 9.26%, 11.44%, and 10.53% respectively over 2 trading days. The U.S. bond market experienced panic selling, with the 10-year Treasury yield rising 48 basis points to around 4.5% during the week ending April 7th, while the 30-year Treasury yield approached the 5% threshold. The U.S. dollar index fluctuated downward, accumulating a monthly decline of 4.37% to 99.64. This unusual synchronized adjustment across stocks, bonds, and currencies shattered the market's traditional perception of the safe haven aura surrounding U.S. dollar assets. Typically, when U.S. stocks fall, U.S. Treasuries as safe assets attract inflows of risk-averse capital. This time, however, investors chose to vote with their feet, collectively dumping dollar-denominated assets, reflecting a rapid erosion of market confidence in the U.S. dollar's creditworthiness. America's tariff policies have not only disrupted financial markets but also profoundly reshaped global trade and industrial chain configurations. The imposition of tariffs has significantly increased the cost of goods entering the U.S. market, leading to a sharp decline in exports to the U.S. from major economies. These economies have been compelled to actively implement export diversification strategies, redirecting their exports to other low-tariff regions. From January to October 2025, exports from China, Japan, and South Korea to the U.S. declined by 17.7%, 4.6%, and 5.0% year-on-year, respectively, while their exports to non-U.S. regions increased by 9.3%, 4.4%, and 4.1% year-on-year. The U.S.'s share of the global import market continues to shrink, with its decoupling from the global trade system becoming increasingly evident. Simultaneously, the U.S. imposes differential reciprocal tariffs globally and levies a uniform 40% tariff on transshipment goods. This has driven multinational corporations to relocate their industrial chains from high-cost to low-cost regions, significantly altering the speed and direction of global cross-border capital flows. Data from the Society for Worldwide Interbank Financial Telecommunications SWIFT indicates that while overall global trade volume has remained stable since the U.S. tariff impositions, new trends have emerged: smaller order sizes and more dispersed flows. The U.S. exemption of reciprocal tariffs on goods meeting the origin requirements of the United States-Mexico-Canada Agreement USMCA has accelerated the integration of North American supply chains. Supply chain linkages within ASEAN and the EU have also strengthened, leading to a trend of fragmentation in global trade and industrial chain layouts. The shifting trade landscape, intertwined with monetary policy adjustments, has further heightened uncertainty in global financial markets. In 2025, the Federal Reserve conducted its second periodic review of the monetary policy framework, focusing on the Federal Open Market Committee's long-term objectives and monetary policy strategy. On August 22nd, Federal Reserve Chair Jerome Powell delivered a keynote speech at the Jackson Hole Global Central Bank Symposium centered on the Statement on Long-Term Objectives and Monetary Policy Strategy, systematically outlining the latest evolution of the U.S. monetary policy framework, which drew widespread attention from global markets. Compared with the 2020 version of the first periodic review, the newly revised 2025 consensus statement includes 4 major adjustments. First, based on the current economic fundamentals, it no longer prioritizes the effective lower bound on interest rates. Instead, it emphasizes that interest rate policy remains the primary tool of monetary policy, while committing to deploying the full range of tools to support the dual objectives when necessary. Second, it abandons the inflation compensation strategy, shifting from average inflation targeting back to flexible inflation targeting, and underscores the importance of stable long-term inflation expectations. Third, it removes references to the gaps in the level of employment, clarifying that full employment represents the highest level of employment sustainable under price stability. Since the level of full employment cannot be directly measured, employment indicators may occasionally exceed real-time estimates of full employment without necessarily posing risks to price stability. Fourth, when employment and inflation targets conflict, a more balanced approach will be adopted to advance both objectives, fully considering the degree of deviation from the dual goals and the time required to return to target levels. This revision to the Federal Reserve's monetary policy framework responds to the primary contradictions in the current U.S. economic landscape while reflecting the shared challenges facing global monetary policy at this stage. In 2025, major central banks, including the Fed, entered an easing cycle, though the path of rate cuts proved uneven. While U.S. inflation decelerated with November CPI rising 2.7% year-on-year, better than market expectations, factors like tariff disputes, supply chain adjustments, and AI investments introduced structural stickiness and uncertainty to the inflation decline trajectory. Immigration policies have simultaneously reduced both labor supply and demand in the U.S., creating a unique labor market dynamic where employers neither hire nor fire. Meanwhile, massive debt burdens and inflated asset valuations remain dependent on rate cut expectations, further constraining the Fed's monetary policy space. Currently, the Fed faces its most severe internal divergence in over a decade regarding estimates of the neutral interest rate, forcing monetary policy to walk a tightrope between evolving outlook assessments and risk balancing. More critically, the Fed's independence is under challenge, potentially rendering monetary policy more reactive in an era dominated by fiscal dominance. Throughout history, monetary policy independence has remained a contentious issue. Powell sought to defend the Fed's autonomy by revising the consensus statement, providing institutional justification for its interest rate decisions and discretionary judgment on balance. However, significant disagreements persist between the U.S. executive branch and the Fed, with conflicts escalating from budget expenditures to policy frameworks and personnel appointments. Political pressure on monetary policy decisions continues to intensify. Ahead of the 2026 midterm elections, certain domestic factions explicitly advocate for the next Fed chair to adopt a dovish stance, with leading candidates like Harsett and Waller openly supporting rate cuts. Amid potential stagflation risks, frequent supply-side shocks and prominent structural issues have made fiscal expansion the dominant policy. As government debt continues to accumulate, monetary policy is forced to accommodate, potentially resorting to short-term expedient measures. However, the erosion of the Fed's independence and the U.S. dollar's credibility will inflict long-term negative effects on U.S. economic development and the global financial system. The fragility of global financial markets was fully exposed during multiple market disruptions in 2025, beyond the triple whammy of U.S. stocks, bonds, and currencies in April. The sudden Bitcoin crash on December 24, 2025, served as a direct warning of instant liquidity depletion. On that day, Bitcoin's price plummeted over 15% within minutes as massive buy orders vanished instantly while sell orders surged, sending prices tumbling like a kite with its string cut. This phenomenon was not accidental but an inevitable consequence of excessive market leverage and liquidity dependency fostered by prolonged low interest rate environments. For years, low interest rates fostered a path dependency among market participants, who came to believe central banks would inevitably intervene during sharp market declines by injecting liquidity to stabilize markets. These expectations significantly lowered risk vigilance, causing risk premiums to persistently decline and asset prices to severely diverge from actual risks. Market entities, lulled by a false sense of security, continuously increased leverage, accumulating substantial liquidity risks. Even minor shifts in market sentiment could trigger panic selling, causing liquidity to dry up instantly and leading to sharp asset price volatility. More concerning is that today's global financial markets form an intricate web through financial derivatives and cross-border investments. Financial institutions and capital markets across nations are deeply intertwined, exhibiting a domino effect where a single disruption can trigger widespread repercussions. Any critical node experiencing problems could set off a chain reaction akin to the 2008 Lehman Brothers collapse, rapidly spreading risk globally and ultimately sparking a systemic crisis. By 2025, the interconnectedness of the global financial system has intensified further. Cross-border lending by multinational banks continues to expand, The proportion of cross-border investments in global mutual funds keeps rising, and the scale of financial derivatives markets has surpassed $100 trillion. These developments accelerate the transmission of risks across global financial markets and broaden their impact. For instance, as the core of global liquidity and the benchmark for asset pricing, any fluctuation in the U.S. Treasury market could impact other nations' financial markets through channels like cross-border investments and exchange rate transmission. A panic sell-off in the U.S. Treasury market would inflict severe shocks on the entire global financial system. From a historical cyclical perspective, 2026 emerging as a critical window for global financial risk is no coincidence. This aligns closely with the predictions of the 18-year economic cycle theory. By analyzing over 200 years of global economic data, this theory reveals that global economic prosperity cycles follow an approximate 18-year pattern. Since the 1819 panic of 1819 in the United States, major financial crises or economic recessions have occurred roughly every 18 years worldwide. Major economic upheavals such as the 1837 U.S. financial panic, the 1857 global economic crisis, the 1929 Great Depression, and the 2008 subprime mortgage crisis all broadly followed this pattern. Based on this pattern, the 18th year after the 2008 financial crisis falls precisely in 2026, providing crucial historical grounds for predicting a potential new financial crisis in that year. It must be clarified that economic cycles are not mechanical clocks. Their progression is subject to disruption by external factors such as wars, technological revolutions, and government policy interventions, which can distort the cycle and cause crises to erupt earlier or later than expected. Therefore, the 18-year economic cycle theory represents an empirical summary of historical economic patterns, offering valuable risk warnings but not serving as an absolute basis for crisis prediction. Nevertheless, the current global economy faces multiple risk factors such as elevated debt levels, rapidly rising interest rates, turbulent trade patterns, and intensifying geopolitical conflicts that closely mirror the characteristics preceding historical crises. The convergence of these multiple risk factors positions 2026 as a critical window for the global economy to enter a deleveraging phase. Analyzing from the perspective of the debt cycle, the outbreak of risks around 2026 is inevitable. The 2008 financial crisis was fundamentally a global debt crisis. At that time, the response of major economies did not fundamentally resolve the debt issue. Instead, it shifted private sector debt to the government sector through additional leverage, replacing corporate and personal debt with government debt. This merely postponed the outbreak of the debt crisis rather than addressing the core problem. Over the past decade, the global economy has operated on a borrow new to repay old model, with debt issues never fundamentally resolved but merely temporarily concealed. After 17 years of continuous accumulation, global debt has reached historic peaks, while government's policy space to address crises has significantly narrowed. On the monetary policy front, interest rates have risen significantly from low levels, leaving limited room for cuts. Years of quantitative easing have substantially expanded central bank balance sheets. The Federal Reserve's balance sheet remains around $8.1 trillion, while the European Central Bank exceeds 8.7 trillion euros. Launching another large-scale asset purchase program at this juncture would yield unpredictable outcomes and side effects, significantly diminishing monetary policy effectiveness. Fiscal policy-wise, governments worldwide carry debt at record highs, with fiscal deficits becoming critical. The conditions for implementing large-scale fiscal stimulus, as seen in 2008, no longer exist. Furthermore, many nations face political polarization, intensifying partisan conflicts that reduce policy formulation and implementation efficiency. Even if viable fiscal policies exist, swift execution remains challenging. According to debt cycle theory, when debt accumulates to a point where markets can no longer sustain operations through borrowing new to repay old, resolution ultimately hinges on three paths: debt default, inflationary debt dilution, or severe fiscal austerity. Each of these approaches triggers severe turbulence in economic and financial markets, inflicting significant shocks on the global economy. By 2025, some low-income countries show early signs of debt default, driven by reduced external aid, currency depreciation, and rising debt servicing costs. their debt crises have begun to surface. Without effective resolution, these crises may spread gradually, triggering regional debt crises that could then ripple through global financial markets. The escalating geopolitical conflicts further intensified risks in global financial markets, becoming a significant potential trigger for crisis. By 2025, the global geopolitical landscape underwent profound adjustments. Strategic competition among major powers intensified, while frictions in trade and technology sectors continued to escalate. Conflicts in some regions became protracted wars with dim prospects for peaceful resolution. Tensions in the Middle East persisted, with localized clashes occurring periodically. Uncertainty rose around sensitive maritime areas, with numerous potential flashpoints elevating the risk of direct global conflict. These geopolitical tensions impacted global supply chains and financial networks across multiple dimensions, severely undermining financial stability. First, supply chain restructuring and decoupling have reduced the efficiency of global industrial chains, driving up production and transportation costs for businesses and further intensifying global inflationary pressures. The realignment of global trade patterns triggered by U.S. tariff hikes essentially constitutes a forced restructuring of supply chains, compelling companies to reconfigure their industrial chains. This increases investment and time costs, leading to higher product prices. Second, economic sanctions have become a common tool in geopolitical rivalry, disrupting international payment systems and trade channels while accelerating de-dollarization and undermining the global monetary system. The US's frequent imposition of financial sanctions on other nations, freezing their dollar-denominated assets, has heightened awareness of the risks inherent in excessive reliance on the dollar system. Consequently, more countries are accelerating the development of diversified payment systems, further eroding the dollar's international standing. Finally, should large-scale military conflicts erupt, critical maritime routes and energy transport corridors could be severed, triggering global surges in energy and food prices. This would intensify inflationary pressures, with multiple crises compounding to cause severe financial market turbulence. The warning from seasoned investors that trade wars often escalate into real wars is not alarmist rhetoric but a profound insight into the intertwined nature of geopolitical conflicts and financial risks. A vicious cycle has formed between geopolitical tensions and financial system vulnerabilities, jointly amplifying global economic and financial risks. On one hand, economic downturns and mounting debt pressures exacerbate domestic social conflicts. Governments in some nations may adopt hawkish foreign policies to divert domestic pressures, further escalating geopolitical tensions. On the other hand, confrontational diplomatic stances increase economic uncertainty, hinder trade and investment activities, and exacerbate recession and debt problems. This creates a vicious cycle of geopolitical tension gives economic setbacks gives worsening debt gives escalating domestic conflicts gives heightened geopolitical tension, trapping global economic and financial development in a predicament. Considering the current global economic landscape and various risk factors, a financial crisis erupting in 2026 could unfold in three typical scenarios. The first scenario involves the spread of sovereign debt crises. If major economies with high debt levels, such as Japan and Italy, experience massive sell-offs of government bonds, bond yields would surge dramatically, breaching market psychological thresholds. This would trigger widespread doubts about their debt repayment capabilities, rapidly igniting sovereign debt crises. Given that global financial institutions hold such sovereign bonds as collateral, a debt crisis in any single nation would swiftly trigger liquidity tightening in the banking system and freeze credit markets, causing widespread market turmoil reminiscent of the 2008 financial crisis. Volatility in the U.S. Treasury market throughout 2025 has already repeatedly unsettled global financial markets. Should U.S. debt issues further deteriorate, the scale of the resulting crisis would far exceed that of other nations. The second scenario involves a comprehensive adjustment in asset prices. This scenario may lack a clear trigger, with stock, real estate, bond, and other asset markets experiencing synchronized, gradual yet persistent declines. This would stem from multiple interrelated factors: declining corporate profits, overvalued assets, and tightening monetary policy. Currently, numerous investors and financial institutions rely on rising asset prices to sustain debt repayment. A sustained decline in asset values would worsen their balance sheets, triggering large-scale deleveraging and creating a chain reaction. Unlike the sudden outbreak of the 2008 crisis, this scenario resembles Japan's 1990s balance sheet recession, characterized by prolonged duration, widespread impact, and a slow recovery process, which would inflict long-term negative effects on the global economy. The third scenario involves financial spillovers from geopolitical conflicts. Large-scale military confrontations in critical regions like the Middle East would directly trigger sharp increases in global energy and commodity prices, driving up worldwide inflation. To curb inflation, central banks would be compelled to persistently raise interest rates even amid economic weakness, further intensifying downward pressure on growth. Simultaneously, the conflict would fragment international payment systems, disrupt global capital flows, and potentially exclude certain nations from the international financial system, ultimately triggering worldwide financial turmoil. Crises under this scenario would be sudden and highly destructive, potentially plunging the global economy into stagflation. Regardless of the form in which the crisis erupts, its propagation pathways within the global financial system share common characteristics, progressing through 4 core stages. The first stage involves striking the core nodes of the global financial system. In the initial phase, the crisis will directly impact critical sectors such as the U.S. Treasury market, the dollar funding market, and the global systemically important interbank lending market. These markets form the core of global liquidity and the foundation for asset pricing. Any impairment in their functionality will directly affect global liquidity supply and asset pricing benchmarks, undermining the stability of the financial system. The panic selling in the U.S. Treasury market in April 2025 has fully demonstrated that volatility at core nodes can trigger chain reactions across global financial markets. The second stage involves triggering cross-asset risk contagion. Currently, most institutions in global financial markets employ similar risk assessment strategies and investment models, resulting in significant market homogeneity. When core asset classes experience sharp volatility, it triggers collective selling by various institutions, causing simultaneous declines across equities, corporate bonds, commodities, and other assets with virtually no asset remaining unscathed. The December 2025 Bitcoin crash triggered synchronized adjustments in certain risk assets, validating the potential for cross-asset risk contagion. The third stage involves cross-border risk transmission. After impacting core markets and triggering cross-asset contagion, the crisis spreads from the origin country to other nations and regions through channels like cross-border bank lending, global mutual fund investments, and supply chain finance. Emerging market economies, with their open capital accounts and limited foreign exchange reserves, are most vulnerable and struggle to effectively counter capital outflow pressures. By 2025, multiple emerging market economies had already exhibited signs of currency depreciation and capital outflows. Should a global financial crisis erupt, these nations would bear the brunt of the impact. The fourth stage involves the transmission of financial risks to the real economy, creating a vicious cycle. Persistent financial market turbulence would drive up corporate financing costs and constrict funding channels, constraining business operations and leading to reduced investment and workforce reductions. Simultaneously, shrinking household assets will reduce consumption willingness and capacity. The dual contraction of investment and consumption will trigger a recession in the real economy and rising unemployment. This economic downturn will further exacerbate declining corporate repayment capacity and rising household default rates, worsening financial market conditions. Ultimately, this creates a vicious cycle of financial turmoil, gives real economy recession, gives greater financial market turmoil, plunging the global economy into an intractable predicament. Facing this potential financial crisis, global market participants must adopt targeted countermeasures aligned with their respective roles. This not only concerns their own survival and development but also impacts the stability of the global financial system. For policymakers, the core task now is to anticipate risks and prepare for potential crises. First, conduct a comprehensive assessment of fiscal sustainability. Reasonably control debt levels, optimize fiscal expenditure structures, reduce non-essential spending, and channel funds into sectors with long-term benefits such as the real economy and technological innovation. Second, thoroughly identify risk points within the financial system. Improve financial regulatory frameworks, plug regulatory loopholes, strengthen oversight of shadow banking and financial derivatives markets, and prevent cross-market and cross-regional risk transmission. Finally, preemptive crisis response plans must be developed. International policy coordination strengthened, and policy reserves established to address potential crises. The lessons from the 2008 financial crisis demonstrate that coordinated international action is crucial for resolving global financial risks. Nations should now set aside geopolitical conflicts, build cooperative consensus, and jointly tackle global economic and financial challenges. For investors, the core principle is maintaining rationality and adhering to the capital preservation baseline. Against a backdrop of rising asset prices and accumulating bubbles, one must overcome greed and herd mentality, maintain clear-headed awareness, avoid blindly chasing highs, and deeply recognize that asset prices cannot perpetually rise detached from economic fundamentals. Strictly control leverage levels, eliminate high-risk operations, maintain financial stability, and avoid forced liquidation due to market volatility. Achieve substantive asset diversification by spreading holdings across different asset classes and geographic regions to effectively disperse risk. Never put all your eggs in one basket. Simultaneously, investors should closely monitor global economic and financial developments, particularly critical risk points like U.S. debt levels, Federal Reserve monetary policy adjustments, and geopolitical conflicts to promptly adjust asset allocation strategies and implement risk hedging. While ordinary individuals need not engage in professional asset allocation, they should remain attentive to shifts in economic and financial markets and prepare accordingly. First, individuals should establish sound personal financial planning, manage debt levels, avoid excessive consumption, and maintain sufficient emergency funds to withstand potential unemployment risks during economic downturns. Second, enhancing professional skills improves job stability, as workers with core competencies are more likely to secure employment during economic cycles. Finally, maintaining rationality amid market volatility is crucial, avoiding panic-driven decisions that could lead to asset losses. Stable consumption and rational behavior by ordinary citizens also form a crucial force in resisting financial crises. From a long-term perspective of global economic development, should a financial crisis erupt in 2026, it may compel nations worldwide to confront long-standing unresolved issues, driving fundamental reforms in the global economic and financial system. Historical experience shows that major crises often herald major transformations. The outbreak of crises prompts countries to acknowledge systemic vulnerabilities, spurring institutional innovation and systemic reconstruction. Following the Great Depression of 1929 to 1933, modern macroeconomics gradually took shape as nations began prioritizing government economic intervention and established robust financial regulatory frameworks. After the 2008 financial crisis, global financial oversight significantly strengthened, with macroprudential policies becoming central tools for central banks worldwide. Should the potential 2026 crisis materialize, it could drive profound transformations across three key domains of the global economic and financial system. First, establishing a global debt restructuring mechanism. The current international financial system lacks a unified, effective global debt restructuring mechanism. When a sovereign debt crisis erupts in a country, solutions are limited to ad hoc negotiations, resulting in inefficiency and limited impact. The debt crises in some low-income countries in 2025 have already exposed the severity of this issue. The potential crisis in 2026 will make countries fully recognize the urgency of establishing a global debt restructuring mechanism, providing institutional safeguards for resolving sovereign debt issues. Second, drive the restructuring of the global monetary system. As the credibility of the US dollar continues to weaken, the trend of de-dollarization accelerates. The 2026 crisis will further propel this process, steering the global monetary system toward multipolarity. Central banks worldwide will further optimize their foreign exchange reserve structures, reducing reliance on dollar-denominated assets while increasing allocations to gold, euros, renminbi, and other currencies. Concurrently, The development of digital currencies and central bank digital currencies (CBDCs) will introduce new approaches and tools for restructuring the global monetary system, potentially transforming traditional international payment and settlement models. Third, restructuring the global economic growth model. The crisis will force nations to fully recognize the unsustainability of debt-driven growth, propelling the global economy toward more sustainable and inclusive growth patterns. Countries will prioritize the development of the real economy, driving industrial upgrading and technological innovation to enhance core growth drivers. Concurrently, increased investment in social welfare sectors will narrow wealth gaps, stimulate effective social demand, and restore economic growth to a normal trajectory of production-demand alignment. The World Bank's 2025 Global Inequality Report reveals that from 2008 to 2025, the wealth share of the world's richest 10% rose from 55% to 62%, with the wealth gap continuing to widen. If left unaddressed, this issue will severely constrain the long-term development of the global economy. Furthermore, the crisis will prompt countries to rebalance the relationship between economic security and globalization, with increased attention to supply chain vulnerabilities. While advancing globalization, nations will strive to build secure, autonomous, and controllable industrial and supply chains, achieving synergistic development between globalization and economic security. The realignment of the global trade landscape in 2025 already reflects this trend, which will become more pronounced in the future. It must be recognized that realizing these transformations faces numerous challenges. Ultimately, success depends on whether world leaders can demonstrate the vision and responsibility to set aside geopolitical conflicts and forge cooperative consensus. Whether the international community can achieve coordinated collaboration to jointly address global economic and financial challenges. And crucially, whether society at large can form broad consensus to support governments in implementing structural reform policies. Looking back at the warning issued on Christmas Eve 2025, its core rationale stemmed from in-depth analysis across multiple domains: global debt dynamics, shifts in market psychology, historical crisis patterns, and geopolitical conflicts grounded in robust empirical foundations. The primary purpose of this warning was not to instill market panic, but to alert market participants to the structural vulnerabilities currently plaguing global financial markets. Long-term accumulated debt issues, escalating geopolitical risks, and diminishing policy response capacity have placed the global economy in a high-risk state. History has repeatedly demonstrated that crises often erupt when market sentiment is most optimistic and risk vigilance is lowest, as was the case with the 2008 financial crisis and as is true of global markets at the end of 2025. The apparent prosperity of global markets at year-end 2025 serves precisely as a breeding ground for accumulating risks, with this pervasive optimism itself being the most dangerous signal. Hegel once observed that the only lesson humanity learns from history is that it never learns from history. 17 years have passed since the 2008 financial crisis. Yet global debt levels are higher, asset bubbles larger, and financial systems more complex, with risks accumulating significantly. Whether the warnings about a 2026 financial crisis will materialize remains uncertain. But ignoring these risk indicators is clearly unwise. Policymakers, investors, and ordinary citizens alike must maintain clear-eyed awareness, exercise prudent decision-making, and prepare in advance. Only through such vigilance can we better navigate future uncertainties, safeguard the stable operation of economic and financial systems, protect personal assets, and ensure the global economy swiftly returns to a path of stable development after the storm.